The position is $2.3 billion short. The underlying is not a stock. It is a country. Specifically, it is the sovereign debt of a mid-tier emerging market economy with a population of 44 million people, a current account deficit running at 4% of GDP, and a central bank governor who gave an interview last Tuesday that told you everything you needed to know. Not what he said, what he avoided saying. You have been building this position quietly for 11 weeks. Nobody outside this room knows the full size. That is not an accident. That is the strategy. You are a macro portfolio manager at a global hedge fund managing $14 billion in assets. You have shorted currencies before. You have shorted sectors, credit instruments, rate structures. This is different. This time, the thing on the other side of your trade is a government. And on the other side of that government are 44 million people who do not know your name and will never understand what is about to happen to the purchasing power of their savings. You have been watching this economy for 14 months. The thesis started as a note in the margin of a central bank press release. 3 words in the governor's statement were different from the prior month. The change was grammatical on the surface. Underneath it was structural. You pulled the full foreign exchange reserve data. The disclosed number was $31 billion. The usable number, after stripping out encumbered reserves, IMF SDR allocations, and currency swap lines that could not be deployed without triggering a separate set of obligations, was closer to $11 billion. The country had $47 billion in external debt maturing within 18 months. The arithmetic was not complicated. The gap between what the market believed and what the numbers said was the trade. You started building the model the same afternoon. By week 3, the model had 140 variables. By week 7, it had a conclusion. The position construction took 9 weeks. You could not move at scale without moving the market against yourself. You entered through 3 separate instruments across 4 execution windows. Sovereign CDS, first, quiet, liquid, bilateral. Then currency options, deep out of the money, structured to give you asymmetric exposure without showing your hand in the spot market. Then a short position in the country's dollar-denominated Eurobonds, sized carefully, purchased through 2 prime brokers who did not know the other existed in the same thesis. You are not the only fund in this trade. You know of at least 2 others who have arrived at the same conclusion through different models. You have not spoken to either of them. You do not need to. The market will coordinate the pressure without any coordination between you. That is how it always works. The thesis does not require conspiracy. It requires convergence. Multiple funds reading the same data and arriving independently at the same trade is not manipulation. It is the market functioning exactly as designed. The fund does not need to trigger the crisis. The crisis is already present in the numbers. The fund simply needs to be correctly positioned when the market stops pretending otherwise. Week 11. The currency has moved 4.2% against the dollar in the past 6 trading sessions. The central bank has intervened twice. Both interventions held for less than 48 hours. The second intervention was smaller than the first. That is the tell. A central bank that is confident in its reserves does not reduce the size of its interventions. It increases them. You update your reserve depletion model. At the current rate of intervention, usable reserves fall below the critical threshold in approximately 31 days. You add a confidence interval. The range is 24 to 38 days. Either end of that range means the same thing. The currency peg breaks, or the government requests an emergency IMF program. Both outcomes are profitable for your position. One of them is significantly more profitable. The local press is running stories about monetary stability. The finance ministry issues a statement describing the currency pressure as temporary and technically driven. You read the statement carefully. The word temporary is doing the work that temporary always does in these situations. It is a placeholder for a decision that has not yet been made publicly. You sleep 5 hours. You return to the desk. The moment the trade becomes something other than a trade arrives on a Thursday afternoon. A journalist from a financial news wire calls your investor relations desk. He is writing a piece on speculative pressure against the currency. He has your fund's name, not the position size, not the instrument breakdown, just the name attached to the thesis, sourced from somewhere you cannot identify. You do not call him back. Your general counsel issues a standard no comment. By Friday morning, the Wire story is live. By Friday afternoon, it has been picked up by 3 domestic news outlets inside the country. By Friday evening, a government minister has named your fund by name in a statement describing speculative attacks by foreign capital against the national currency. The word attack is doing significant work in that sentence. You modeled this scenario. You called it the political response phase. You knew it was coming. Knowing it was coming does not make it feel the way you expected it to feel. You read the minister's statement twice. You close the browser. You pull up the position screen. Day 34. The central bank announces an emergency rate hike of 500 basis points. The currency stabilizes for 72 hours. Your options position loses $180 million in mark-to-market value across those 3 days. You do not close. The rate hike is not a solution. It is a signal that the solution is running out. A 500 basis point hike in an economy with a debt to GDP ratio of 78% and a corporate sector already paying 14% on local currency loans does not fix a balance of payments crisis. It buys time. You know exactly how much time it buys because you have modeled every previous episode of this kind going back to 1997. The average duration between emergency rate hike and eventual devaluation across 11 comparable historical cases is 47 days. You update the timeline, you hold the position. Day 51. The IMF confirms it has received a formal request for emergency financing. The currency falls 18% in a single session. Your CDS position generates $340 million in gains before the close. The Eurobond short adds another $190 million. The currency options, the ones that were deep out of the money 11 weeks ago, are now in the money by a margin that triggers automatic exercise on a portion of the book. Total mark-to-market gain on the position across the day is $611 million. You are sitting at a terminal in a glass-walled office on the 31st floor of a building in Midtown Manhattan. Outside, it is raining. You watch the numbers settle. You feel something that is not quite satisfaction and not quite guilt. It is closer to the feeling of a model being confirmed, of a thesis resolving exactly the way the data said it would. The market was wrong, you were right. That is what the number means. You know that in the country whose currency just moved 18% in a single session, imported goods will be 18% more expensive by the end of the week. You know what that means for a median household income of $620 per month? You do not dwell on it. Dwelling on it is not part of the process. The process is the model. The model was correct. The position closes over the following 3 weeks in structured tranches designed to minimize market impact on the exit. Total net realized gain, $870 million. The fund's year-to-date performance moves from flat to up 22.4% in a single quarter. Your carried interest on the fund's performance for the year will exceed $40 million. 2 months later, you are asked to present the trade at an internal investment review. You walk through the thesis construction, the position sizing, the execution sequencing, the political response phase, the IMF trigger. The room listens carefully. Several people take notes. At the end, a senior partner asks you one question. He asks whether you think the trade accelerated the crisis or simply profited from one that was already inevitable. You pause for 4 seconds. You say the fundamentals were the cause. The position was the observation. He nods. The meeting moves to the next item on the agenda. You believe what you said. You also understand that the distinction between observing a fire and deciding not to warn anyone about it is not a distinction the people inside the building would find meaningful. That question does not appear in any model you have ever built. It lives in a different part of the architecture entirely, the part with no output cell. Subscribe to Adrian Finance for more stories about how money actually moves.